If you look at the financial headlines today, you see one story. You see Nvidia. You see a stock chart that looks like a vertical line. You see a mania that feels like the dot-com bubble and the gold rush rolled into one. But I am here to tell you that most investors are looking at a mirage. While the world is mesmerized by the flashing lights of AI chatbots and image generators, something much bigger, much heavier, and much more expensive is happening in the shadows. There is a capital wave forming that is so large, it's hard to wrap your head around it. We are talking about $7 trillion. That is not my number. That is the projection from McKenzie and Company. They state that data center infrastructure is set to grow between 14% and 23% every single year for the next half-decade. To put that in perspective, this is the largest physical industrial buildout since the expansion of the American railroads in the 19th century. Old black and white footage of railroads being laid, transitioning to modern time-lapse of a server farm being built. When the railroads were built, fortunes weren't just made by the people riding the trains. They were made by the people laying the steel, smelting the iron, and owning the land. Today, everyone is asking, where are all these Nvidia GPUs going? The answer isn't a mystery, but it is a logistical nightmare. They are being packed into buildings, the size of football fields, modern fortresses that consume more electricity in a single year than the entire state of Alaska. I've seen this firsthand. Years ago, I worked on machine learning pricing models for Amazon. Back then, it was just math. Today, it is an arms race. And this race isn't just about code. It's about concrete, copper, and voltage. In this video, I am going to break down exactly where that $7 trillion is flowing. I've built a massive spreadsheet tracking every public company involved, from the chip designers to the guys pouring the cement. And by the end of this video, you will know exactly how to position your portfolio for the next 5 years. The thermodynamics of money. Let's talk about the physics of AI, because you can't understand the investment thesis if you don't understand the heat. Goldman Sachs recently released a report expecting data center power demand to jump 165% by 2030. Why? Because an AI server is not a normal computer. When you type a prompt into ChatGPT, that request is routed to a physical location. Let's look at Elon Musk's new Colossus cluster in Memphis. It uses 100,000 Nvidia H100 GPUs. Speaker. One of these chips consumes roughly 700 watts of power. Now, pack 100,000 of them into a building. The heat generated is so intense that if the cooling systems fail, the hardware would melt itself down in minutes. You cannot cool these with air conditioning. You need industrial-grade liquid cooling. You need dedicated substations. The grid, the actual U.S. power grid, is not ready for this. We are running out of power. This is why I've been covering nuclear stocks for the last 2 years. AI does not run on hopes and dreams. It runs on massive, stable, base-load electricity. Speaker. This brings us to the core of the McKenzie report. They break that $7 trillion down into 2 buckets. And if you get this split wrong, you lose money. 60% of the money goes to compute. 40% of the money goes to facilities. Think of it like a race car. The compute is the engine the Ferrari V12. It's fast, it's expensive, and it gets obsolete quickly. The facilities are the racetrack. It's the asphalt, the pit crew, the fuel. It doesn't matter which car wins. The track owner always gets paid. Let's deep dive into these layers, starting with the one getting the most hype, the compute layer. Fast-paced editing, silicon wafers, robots manufacturing chips. The compute layer is where the hypergrowth lives. This is that 60% bucket. If you want 30, 40, or 50% annual returns, this is where you look. But it is also the most volatile. Obviously, we start with Nvidia. They are the king. But the kingdom is getting crowded. AMD is gaining real momentum with their MI300 chips. Broadcom and Marvell are designing the custom silicon that connects everything together. But there is a hidden bottleneck here that most retail investors miss: memory. A GPU is useless without memory, specifically high bandwidth memory, HBM. Imagine having a Ferrari engine, but feeding it fuel through a straw. That's a GPU without HBM. The companies that make this Micron, Samsung, SK Hynix are sold out. They are backlogged for years. You simply cannot build an AI data center without paying a toll to these three companies. Then we have to talk about the companies that actually screw these things together. Supermicro Computer, SNCI, Dell, Hewlett-Packard Enterprise, Lenovo. These companies take the chips from Nvidia, the memory from Micron, and they build the racks. And finally, the nervous system, networking. If you have 100,000 chips, they need to talk to each other instantly to train an AI model. This is where Arista Networks dominates the cloud. This is where Cisco fights for the enterprise. And deep in the weeds, you have optical companies like Coherent and Lumentum, making the lasers that shoot data across fiber optic cables. This entire layer moves at the speed of light. Technology here changes overnight. One new chip design can wipe out a competitor. It is high risk, high reward. Now, let's slow down. Let's look at the other 40%, the facilities. This is the unsexy side of II. This is the sleep well at night money. These companies grow at 10% to 15% a year. They aren't flashy, but they are essential. If Nvidia releases a bad chip next year, Nvidia stock crashes. But the data center building? It still needs power. It still needs cooling. It still needs security. First, power and thermal management, Vertiv. You might not have heard of them, but they are the giants of data center cooling. As chips get hotter, Vertiv's backlog grows. Eaton and Schneider Electric. They handle the switchgear, the breakers, the power distribution units. Then, look at the grid itself. Quanta Services, Siemens, ABB. These are the companies physically building the power lines to connect these massive AI factories to the grid. And what happens when the grid fails? You need backup power. Bloom Energy, Caterpillar, Cummins. Data centers need 99.999% uptime. If the power cuts for a second, millions of dollars of training data can be corrupted. So, they buy massive generators. And finally, the landlords. Equinix, Digital Realty, Iron Mountain. These are real estate investment trusts, REITs. They own the physical buildings. They lease the space to Amazon, to Microsoft, to Meta. They are betting that the demand for physical space for the internet will never go down. And looking at the last 20 years, that is a very safe bet. So we have the compute, the machines, and the facilities, the buildings. But there is a third group, the puppeteers, the hyperscalers, Amazon, AWS, Microsoft, Azure, Google Cloud. McKenzie's 60-40th split applies to the industry, but these three companies sit above the industry. They are the ones writing the checks. Here's what is changing. They are tired of paying the Nvidia tax. They are now designing their own chips. Amazon has Trainium. Google has TPUs. Microsoft has Maya. Amazon just last week deployed its own in-house liquid cooling system because they couldn't wait for the supply chain to catch up. These companies are verticalizing. They own the chip design, the server build, the data center, the fiber optic cables under the ocean, and the cloud platform you use. They are the safest way to play this. They capture value no matter where it goes. Before I show you exactly how I am splitting my money across these sectors, I need to mention where I get a lot of my macro data. Our sponsor, Fundstrat, founded by Tom Lee. You've seen Tom on CNBC. He's the guy who called the V-shaped recovery after COVID when everyone else was panicking. FS Insight gives you the institutional-grade research macro, crypto, technicals that is usually reserved for hedge funds. If you want to move from guessing to knowing, check the link in the description. Now, let's get to the portfolio strategy, the $100 strategy. How to invest? A clean pie chart graphic appearing on screen, filling up as the speaker talks. Knowing the players is step 1. Knowing how to allocate capital is step 2. If I have $100 to invest in the data center build-out today, I am not doing a 50-50th split. I want maximum upside with a safety net. $45 goes into compute. Nvidia, Micron, Arista, SMCI. This is the growth engine. This is where the 20 to 25% annual gains come from. The demand is still red hot, and we are early in the cycle. $30 goes into hyperscalers. Amazon, Google, Microsoft. This is my ballast. These companies are cash-printing machines. Even if AI slows down, they still own the internet. $25 goes into facilities. Vertiv, Eaton, Digital Realty, Quanta Services. This is the hedge. This is the infrastructure play. It lowers the volatility of the portfolio. If we look at conservative growth estimates, compute grows at 20%, hyperscalers at 12%, facilities at 8 to 10%. In 5 years, that portfolio mathematically doubles or triples without relying on a single moonshot penny stock. By 2030, we are going from 81 gigawatts of capacity to 222 gigawatts. The grid is being rebuilt. The internet is being physically expanded. The $7 trillion check has already been signed. The only question left is, are you going to position yourself to catch the flow? I've linked the full spreadsheet with over 100 tickers below. If this deep dive gave you value, smash that like button so the algorithm knows you want more serious content.